One day after China's decision to let the Yuan strengthen, the currency is trading weaker. A surprise to some, maybe, but not to Gary Shilling. Gary told us back in April that, if anything, a free-floating Yuan probably would weaken against the dollar. He's an independent economist who advises hedge fund manager John Paulson, and, as Bloomberg Businessweek pointed out in a recent cover story, a contrarian who nailed all 13 of his investment guidelines for 2008, and boy, was 2008 a tricky year. Gary is back with us here in New York this morning. Gary, I got to be fair to China. The Yuan is not free-floating, but it's weakening today. Let me ask you this question, because you have been outspoken on China. Is the Chinese government, is the central bank, in your mind, making the wrong move here?
It probably is. They run a stop-go economic policy, and the last time they tried to slow things down was 2007. The timing couldn't have been worse because it came right on the eve of the '08 global recession. Now they're trying to slow things down, and letting the yuan go up against the dollar is part of that tightening move. They're worrying about inflation, but they're really trying to tighten down after all their massive stimulus last year, and the timing probably is going to be terrible because we're getting the Eurozone crisis spreading globally, and that may give us a sequel to what subprime mortgages did in '08.
A sequel to what subprime mortgages did.
Sad,
so how apocalyptic a vision should we have?
Well, it's not the end of the world, but I think it's mainly financial. It isn't so much in trade, although obviously if Europe is in weak conditions, they're not going to buy much of anything, including our exports. But the point is that U.S. banks have 48% of their global exposure, $1.5 trillion in the Eurozone plus the UK. So there's a lot of involvement there, and I think we probably are going to end up with restructuring, meaning lower value on the debts, sovereign and private debts in Greece and probably Spain and a few other of the pigs.
Okay, but as we've heard about, there's been so much talk about a potential restructuring in Greece. You're talking about a technical default, let's call it, by Spain, by Portugal, by other countries potentially.
Very, very well could be. It depends on how, and there are lots of ways that they sort of handle things. Like in the mid-'70s, New York City never technically went bankrupt, but it really was. It had to be bailed out by the state. They didn't meet the interest payments on their debt. There's a difference between technical default and actual default, but I think that's coming.
But how is this going to play out? Because I've heard that maybe some of the big banks in Germany and France are swapping the debt that they have of Greece, Spain, and Portugal with the ECB, so it all ends up sitting on the ECB's balance sheet. If that's the case, what's the scenario? Yeah,
and the suggestion is that the ECB should sell that, in effect, to this big fund, this backup fund that they have set up. The Greeks have actually proposed that. But that's what's going on, Eric, globally. It's a socialization of debt. It's taking it over by by a government or by a super government agency.
We are back with independent economist Gary Shilling. I call him the contrarian because every time you hear everyone else cheering, it's a Bronx cheer from Gary Shilling, and that's what he's got for China this morning. Yesterday, Gary, it seemed just about anybody, wherever you looked, was applauding China's move to allow the UN to strengthen ahead of the G20, politically shrewd, etc., etc. You were just saying earlier that there are some risks to that move. Let's go into them a little further, though, because I think people need to understand this. China's stated objective is stimulating domestic demand. But as you pointed out, the net effect here is going to be a tightening of monetary and fiscal conditions. And at the same time, Jing Ulrich of J.P. Morgan Chase was telling us yesterday that this could trigger hot money inflows, foreigners anticipating a managed appreciation of the yuan, buying more Chinese stocks, buying more Chinese properties. So add it all together, what's going to happen?
Yeah, well, it's a damned if you do, damned if you don't situation. And that's what's happened when you're in a globalized world and you have an economy which is really trying to regulate things away from market forces. Unless you're a hermit kingdom like North Korea, it's pretty hard to do. And that's what happened to China the last time when they were, from 2005 to 2008, when they allowed the currency to appreciate. A lot of hot money came in anticipation of even higher value of it, and it offsets what they're trying to do. And as far as they're stimulating the domestic economy, hey, that's fine, but they don't have big enough middle class right now to do that job. That's a decade away. So there's a lot of moving parts here, and they're having trouble getting them all over. If they just had an open economy, it's only much easier. The markets sort that out. but they're still trying to control it very tightly.
Well, for your sake, Gary, I hope the Chinese policymakers are listening, but let's assume for a moment that they're not, or if they are, they don't care. Give us a prediction. How is this likely to end up if, in fact, the Chinese do what Jing said and allow the currency to appreciate by, say, 4 or 5% on an annual basis?
Well, first of all, they can sterilize hot money coming in. They can simply buy it up, in effect, by the central bank. They can offset that, and they've done that in the past. I think the net effect here is that China is going to see the stop phase. They're worried about the big loans that have been made by provincial governments for infrastructure projects. They do that with off-balance sheet techniques, very much like the U.S. did. They're worried about the property market, which has gotten out of control. Last year, there was 8.9% real GDP growth in China. 8.0 of 8.9 was in the construction area. They're trying to slow that down. I think they're going to see the stop phase, and it is unfortunately coinciding with the problems in Europe, as we talked earlier. So I rather suspect their growth rates, which are now in double digits, will go back to the 6 or 7% area, which for China is a recession.
Gary, let's go back to Europe and try to bring it home here to the United States. You talked about the risk of sovereign defaults in Europe, but Europe is trying to do something about it. Austerity measures in Spain, in France, in Germany. Today we're going to get it from George Osborne in England. What do we need to be doing here in the United States? Because you're a big bull on treasuries,
right?
Yet when it comes to treasuries, the single biggest risk looming out there at some point in the future is this gargantuan deficit that we've accumulated.
Well, you're right, but that sometime is a long way, and it's a lot further out than the rest of the world because the U.S. is the safe haven. I mean, we have the luxury of being profligate longer than the rest of the world because people want the dollar and they want treasuries as the safe havens in the world. So we can get away with it longer than anybody else. If some other currency came along, some other economy, maybe China, but I think that's a couple of decades down the road anyway. If they had an open economy, freely floating currency, that were an alternative to the dollar, then the squeeze would be on the U.S. But in the meanwhile, the U.S. doesn't have the pressure, even though Congress is starting to tighten up a bit.
Gary, great to have you. A bull on treasuries, perhaps a bear on China. Gary Shilling here on the Inside Track.